Ready for some excitement? Let's dive into something really fun together. If you're starting to invest after 35 in India, especially in mutual funds, it's all about boosting your savings and making smart choices to catch up. While starting early offers the benefit of long-term compounding, it's definitely not too late to build a substantial corpus. Here's a comprehensive guide. Take a good look at where your finances stand right now and what you want to achieve. Assess your current financial situation and goals. Financial health check. Understand your income, expenses, existing savings, and any outstanding debts. Prioritize clearing high-interest debt. Define your goals. Make sure you know what you're investing for, like retirement, your kids' education, or saving for a house. Set specific amounts and timelines for each goal. This will help you figure out your investment strategy and how much risk you can handle. Define your goals. Figure out exactly what you're investing for, like retirement, your kids' education, or a new home. Set clear amounts and timelines for each goal. This will guide your investment strategy and risk level. Categorize expenses. Split your expenses into needs like rent and food, and wants like dining out and subscriptions. Risk tolerance. Once you hit 35, you probably have more financial responsibilities, right? Your risk tolerance might dip a bit compared to your 20s. It's all about finding that sweet spot between growth and comfort. Next step is boosting your savings rate is super important, especially when you want to catch up. Aggressive SIP. Since time's not on your side, it's super important to ramp up your investments. Seriously, consider boosting your systematic investment plan amounts. Even just a 10% annual increase in your SIP can really help grow your savings over time. Pretty neat, right? Identify areas to cut expenses. Look for ways to reduce discretionary spending and redirect that money towards investments. Utilize salary increments as your income grows. Make a conscious effort to invest a substantial portion of your raises. Next step is to concentrate on boosting passive income, strategic mutual fund choices. Given your age and the need to catch up, a good blend of growth and stability is key. Equity mutual funds, diversified equity funds, these are a cornerstone for long-term wealth creation. Flexi-cap mutual funds provide diversification across large, mid, and small-cap companies, allowing fund managers to adapt to market conditions and capture growth opportunities. Hybrid mutual funds, balanced approach, balanced advantage funds. These funds dynamically manage their asset allocation between equity and debt based on market valuations, aiming to provide reasonable returns with lower risk. Aggressive hybrid funds. These funds invest a minimum of 65% in equities and the rest in debt instruments. They offer a balance of growth and relative stability, making them suitable for those who want equity exposure with slightly lower volatility than pure equity funds. Let's dive into some super important key investment principles that everyone should know. Systematic investment plans. Continue with SIPs as they help in RUPA cost, averaging, and instill investment discipline. Long-term horizon. Even at 35 plus, you still have a good 20 to 25 years until traditional retirement age. Maintain a long-term perspective to ride out market fluctuations and benefit from compounding. Diversification. Don't put all your eggs in one basket. Diversify your investments across different fund categories, asset management companies, and even investment styles. Regular review. Periodically review your portfolio's performance at least once a year and rebalance. If necessary, to align with your financial goals and risk appetite, avoid market timing. Trying to time the market is generally not effective. Stick to your SIPs regardless of market ups and downs. Direct plans. Opt for direct plans of mutual funds as they have lower expense ratios compared to regular plans, leading to higher returns over the long term. Just make a note of tax efficiency. Equity funds. Long-term capital gains on equity mutual funds are taxed at 10% for gains, exceeding 1 lakh in a financial year after a holding period of more than 1 year. Short-term capital gains are taxed at 15%. Debt funds. For debt mutual funds bought on or after April 1, 2023. Capital gains are taxed at your applicable income tax slab rate, regardless of the holding period. For investments made before this date, TCG held for more than 3 years was taxed at 20% with indexation benefit. An STCG held for less than 3 years was taxed at your slab rate. Be mindful of these changes. Example, catch-up strategy. If you're starting at 35, aiming for retirement at 60, you have 25 years. You might consider an asset allocation like equity mutual funds, allocation 60 to 75% higher initial allocation, gradually reducing closer to retirement, large cap and flexi cap funds for core allocation, a smaller portion in mid cap or aggressive hybrid funds for higher growth potential, debt mutual funds, allocation 25 to 40%, initially lower, gradually increasing closer to retirement for liquidity and diversification, aggressive hybrid funds. Remember, consistency and discipline are paramount, especially when playing catch-up. Start now, invest regularly, and review your progress to achieve your financial goals. Thanks for watching. Please like and subscribe. See you soon with another interesting video.